Okay, welcome everybody to Wall Street Reporter's next Super Stock live stream, August 20th. We are back with the Reliq Health RQHTF over-the-counter RHT, the TSX venture with Dr. Lisa. Lisa, welcome back.
Thank you. Thanks for having me. Please call me Lisa.
What's that?
Please just call me Lisa. Don't make me sound like Dr. Phil.
No, actually, I like this. I'm going to call you Dr. Lisa because this is going to be like your branding, like these doctors. This is a good thing. So, so for anybody that's brand new to a program, we're always getting new people. So our goal is to bring you at Wall Street Reporter next Super Stock live stream. Our goal is to bring you these stocks which have that 10x to 100x upside potential. Companies going after massive market opportunities, multi-billion-dollar market opportunities. That are also at a key inflection point, and there are also multiple catalysts in place to ignite. And we've already had 7 stocks in the past 18 months that are up between 1,000% and 5,000%, 10x to 50x, and a whole bunch of others that are 500%, whatever. So we're going to find out if Reliq is going to be that next 10 bagger, the next 1,000% 10x stock. And what I like about this is, what I like about Reliq, Lisa, is that you've actually, you're hitting all 3 of those points. And it's very important that the inflection point, not only have you hit the inflection, but we're already moving past the inflection point. So and we're starting to see the stock pick up. So the timing here is really excellent. I'd like to, before we get into the recent news, yesterday you entered a new market, the HIV patient monitoring market, and other markets you're going into. But I think it's very important for investors to really kind of understand the key, I guess from my perspective, let's say as an investor, is this company right now is you have this massive revenue pipeline that's already, it's basically a done deal. You're going to have this 200,000 plus patients paying, $40 a month, etc. In the next the contract's already in place, and now it's a question of getting them onboarded. But most importantly, you already, a few weeks ago, you hit $1.5 million per quarter, so you're at the profitability. The company's essentially turned the corner to profitability, right?
Yeah. I think if you, the analogy I use most often is it's like you're pushing a tiny little snowball up a hill, and it's very slowly adding to its size, but we've really reached the top of the hill. So at this point, it's all momentum, and it is very much autocatalytic in terms of adding patients. Healthcare customers like to buy by reference, so we're getting a lot more, a lot of inbound calls, referrals from colleagues of clinicians who are working with us, and so through the rest of the fall and certainly into next year and the years to follow, that snowball is going downhill at a very rapid rate, and it's just getting bigger and bigger and bigger. And that's something that in healthcare, the advantage is you have to do a lot of hard work, kind of tilling very hard soil for a few years and planting your seeds. But once you get to the point where you're harvesting, where we are now, that's kind of a recurring annuity, and it just continues to grow and blossom. So, we've done all of that hard work now, and to reap the rewards for our shareholders.
So essentially, I think again the healthcare industry, like the space that you're in, it's a very it's a conservative space. So again, it took a couple of years to get to the point where you are now. It took a lot longer than people were expecting, but at this point, you're really essentially positioned to be like the incumbent in the space, and it's very hard to replace an incumbent, kind of where you have that recurring revenue, kind of where you're going to be, where you are.
Yeah, I mean, if you look at what the analysts say, this market is worth over $160 billion. Even if competitors, enter the space, I think there's room for multiple companies to do exceptionally well. We have the advantage of having been out there for several years. Yes, when we started in late 2017, 2018, we hit up against the challenge of being the first ones to, really offer broad remote patient monitoring services through the brand new Medicare code that was introduced January 1st, 2018. So we had issues with, clients not understanding eligibility criteria, and that first year was definitely a bit of a mess. But since then, Medicare and Medicaid have significantly simplified the claim submission and criteria around receiving reimbursement for virtual care. And they've vastly expanded, from one billing code to well over a dozen, with 5 more coming in next year. And the size of the reimbursement has gone from $59 per patient per month for a clinician in 2018 to $315 per patient per month at the beginning of this year to $372 per patient per month now, US dollars. So, it's such a compelling financial opportunity for clinicians now, whereas when we started, they were barely going to break even. And so now we really get a lot of clinicians calling and saying, we desperately need this revenue, especially with revenues we've lost due to COVID. This is a great way if, the Delta variant does continue on to be an issue, or continue to be an issue in the fall. This is a great way for us to provide care to our chronic disease patients who we do not want coming into the office and exposing themselves to COVID. And so, we've got just tremendous market pull right now, just a combination of tailwinds, Medicare and Medicaid expanding the scope of their programs as well as the level of reimbursement, and frankly, the pandemic making clinicians much more comfortable with the concept of virtual care by necessity. And then now this sort of pending fourth wave has really encouraged a lot of clinicians to figure out a new way to provide healthcare to their chronic disease patients at home. At home where they're safest. And there's a lot of pressure from hospitals to keep these patients out of the hospital. So these are the traditional super users of the healthcare system, and there's no room for them if there's a fourth wave. So it's really created a very strong market pull for our platform, and we see that every day with new referrals coming in and new contracts being signed.
No, there's definitely, so I mean, really, finally, you're at the right place at the right time. You were early a couple of years ago when you started, and again, listen, it's a development stage company. I guess sometimes people don't realize, but yeah, you were a little bit early. Now everything is going right. So okay, so I want to, before we get into to basically the current news, the new markets you're going into, and everything else, and what's up, I want to just recap again the model of what you're doing, and again recap the contracts that are already signed, 200,000, how those numbers work out. Essentially, what I want investors to understand is, okay, what is the path for this stock to be, it could be I don't know, a $5, $10 stock, because essentially right now you're at 150 million market cap roughly. And if you get these 200,000 patients plus, we're talking about a multi-billion-dollar market cap, just based on the comps in the space, what we saw with Teladoc. Okay, so let's go kind of the model of what you're doing, why the doctors, and then we'll go through everything else.
Yeah, so it's a subscription model where we're charging an average revenue per patient per month of $40 US, but that is actually increasing. We found that there's a lot more demand for our care management services, which are really, we have a call center with medical assistants, so very low-cost resources who can act as an extension of the physician's office and provide some of the kind of administrative support around managing patients, and that allows clinicians to bill more to Medicare and Medicaid. It also allows them to onboard a lot faster and to support a much larger number of patients. So we're getting a lot more at that higher price point. So I think by the end of the year, our average revenue per patient will have expanded. And when you talk about the sort of backlog, so we have over 200,000, well over 200,000 patients covered by client contracts. But what we have, when we sign a contract with a client, we also sit down and develop an implementation plan. In some cases, particularly around COVID, for example, skilled nursing facilities really weren't in a position to say, we want to start at this time and we want to add this facility then. And, they were very much preoccupied with dealing with COVID in their facilities. But we do have 200,000 patients whose clinical care providers have sat down with us and developed an implementation plan and signed off on it. So we know that by the middle of 2023, we'll have onboarded at least 200,000 patients through those existing contracts and existing implementation plans.
Oh,
and
so we had the internet connection is a little off right now. So okay, so you said the 200. When did you say in the middle of when they're going to be on? If you can just repeat, because we're getting a little internet delay.
Sorry about that. So we have 200,000 patients who are covered by the implementation plans and contracts, and they'll be onboarded by the middle of 2023, which translates to annual recurring revenues, a run rate of 120 million. And I think that recurring revenue is really the key metric. So we always talk about profitability, growth. Growth is certainly a very key metric. Profitability is as well, but what's really key when I'm talking to the US institutions and to analysts in the space is, what's your recurring revenue going to be? So at the end of this year, even if we only did $1 in revenue, which obviously we're not going to, we'll be doing roughly 11 million for the year, but we'll be hitting a revenue run rate of 24 million annually by the end of this year. That's recurring revenue that will continue indefinitely. I mean, what we find with our clients is that even if patients who are on the platform die, they're immediately replaced by 2 to 3 other patients because the population is constantly growing and aging. So, we don't have any net loss of patients from the platform. It's always growth, even per client. So that's really important. But the key metric for us, what we're really going to be valued on, according to the institutions and the analysts, really it's 2 factors. It's the growth rate and it's that recurring revenue. So hitting that run rate by the end of the year of 2 million a month or 24 million a quarter, at the growth rate, I mean, we ended last quarter, at a revenue run rate of 1.5 million. We'll end this quarter at roughly 3 million, a revenue run rate of 3 million. And then we'll end the year at a revenue run rate of roughly 6 million per quarter. So we're doubling every quarter, which is very unusual in terms of organic growth. I mean, this is a company that grows based on what we have inside the company at this moment. So our asset is our team and our platform, and we're not out buying revenue, we're building revenue, and that revenue is recurring and reliable. And so that's something that's pretty unique in the space, and we have very good margins and very rapid growth. So I think you'll start to see that reflected in the valuations as we become more of a known quantity in the US, which is kind of a focus for us in the U.S. capital market specifically going forward.
Yeah. So basically, right now, okay. So I think again, the company again. One of the issues that the stock, forget about the stock has had is that you guys came out. You were a little bit early. It took a while for things to get going, and people kind of like they didn't believe the story, and now the validation is here because you actually delivered what you said you would do. You got $1.5 million revenues the quarter. The company's going to be profitable. You're going to hit now. The next thing I guess to watch for is this 24 million run rate by the end of December. So in 4 months, that's going to be another milestone. But I think the market is forward looking. So as the news flow happens, obviously the stock and everything can tick up. But the other thing is this. So you're going to have these 200,000 patients. Essentially, they're going to be fully onboarded. So the contracts are there. They're going to be fully onboarded roughly in the next, it looks like 18 to 24 months, right?
Right.
And so this 24 million is going to grow. The run rate is going to be, I don't know, it could be 50 million. But once you're at 120 million revenue run rate, the market could value that at 20x. I mean, I don't know, what did Teladoc buy?
Oh, it was a 74x multiple.
74x revenues.
I think it was revenues. Someone on here will probably know better than I do.
It's crazy.
It's a massive multiple. And I mean, if you look at Teladoc and Livongo, they've lost a lot of market share since they did that acquisition. And because they're very human resource intensive business models, their EBITDA margins are single digit, and that won't improve at scale. Whereas we're a conventional SaaS business. So, our EBITDA margins are over 45% by the end of the year. That's really compelling. That's a business that isn't going to need, frankly, we're probably never going to raise money again. We're at the point where we are profitable. This will be our first full profitable quarter. And by the, end of the first quarter of next year, we'll be throwing off very substantial amounts of free cash. So, we're that sort of rare company that's going to grow organically very rapidly and without needing an infusion of capital. So, I think I saw one question came out that we've issued a lot of stock over the last year, and that's definitely true. We compensated our business development team with stock options to this point, but we're now at a point where we're getting enough meaningful revenue that we've stopped issuing those stock options. And so, those business development executives and other team members, sales team members are being compensated by commission now. So we're not going to have that continued dilution from issuing stock options. Certainly we do see, especially now, warrants being exercised. We see staff, in some cases, exercising options. And, a lot of our business development team exercised options, but, they're not, they're sitting on those. They're not selling them. They really believe in us as a game-changing company, which is why they agreed to be compensated with stock and not, cash.
That's actually, it's an interesting point. So you're saying, your sales team, basically salespeople, so they got paid in options and warrants and not cash, the commissions.
Yeah, it was not cash. It was just options, and they're all still sitting on the options. They, all of them have had so much faith in the company. They've purchased options, and that's been a great vote of confidence for us. We've had at the private placement we did last December included multiple clients as well as some of our internal business development team. So the people who really know what's happening with customers have really bet significantly on the company. But it's very good for us because the people who are involved and who've got skin in the game are really have a lot of skin in the game, and not having to raise going forward means going forward we're not worrying about steadily increasing share count or dilution for the shareholders. So it's a pretty rare combination, in my opinion, that you have a company that's growing this quickly, but it's all organic and it doesn't require a new infusion of capital to do it.
Okay, yeah, that's interesting. Actually, that's one of the issues that we've had with a lot of the companies we're working with. I mean, listen, I always think, look, companies, they need to raise capital, whatever, but investors, seems like in the microcap space and in Canadian microcap space, they get very freaked out with the possibility of a company raising capital. I mean, in the long term, obviously that capital is going to drive further increases in the stock price, as the business grows. But people are very that makes them nervous because the way the way the Canadian markets are structured with,
it's a big difference philosophically between U.S. and Canadian investors. Having started my career in the U.S., generally, a raise, especially for a company that's profitable and is experiencing significant growth, was usually welcomed as a really positive sign that the company was just adding more fuel to the fire. And certainly, if we needed capital, we wouldn't hesitate to add fuel to that fire. Whereas I think in Canada there seems to be a much more of a focus on share count. Whereas what you really want to think about is, if this is a company that, without having the share count we do now, probably wouldn't still exist. We needed the financing we did to get to this point. But this is going to be a very high value stock, whether we had 10 shares outstanding or 10 billion. It's really not going to matter in the end. I think I tend to focus very much more on operations and less on kind of that financial engineering side of things. And I think that translates to building a company that has genuine value. And that's what ultimately drives your valuation.
Okay, I want to get into the recent news and everything. We're going to go into. I want to just get a couple of questions. Actually, a pretty good question. So Evan is asking, what kind of competitors are you seeing in the market now, since more billing codes are coming out?
Yeah. So, what we tend to see are either device manufacturers like Dario, even Livongo has proprietary hardware. It's companies who have their own proprietary hardware, and they might monitor, specific conditions. A lot of it's congestive heart failure, some diabetes, some hypertension. The difference between those companies and us is, physicians hate to be restricted to a particular brand of hardware. It might not be covered by Medicare, Medicaid, so it might not be reimbursable. I mean, Livongo, for example, is not targeting the Medicare, Medicaid space. They target the sort of higher price points of the employer self-insured plans, which are younger, working age, healthier patients. We are unique in having targeted that very challenging Medicare, Medicaid population. The average patient is over 70, has multiple clinical conditions, so they're quite ill, and they often are living in remote and rural communities with limited infrastructure, so they may not have internet in their community, let alone in their home, and they're not tech savvy and they're not interested in becoming tech savvy. So we're easily able to displace device manufacturers who have got contracts with doctors, and they will switch to our platform very quickly, because with us you can monitor all of your patients, not just patients who are able to pair things with Bluetooth or who only have 4 different conditions. We can manage manage and monitor high-risk pregnancy patients, mental health and addiction patients, patients who are being seen by specialists, patients who are post-discharge from skilled nursing. So we have a much more flexible and powerful platform than anybody else out there. We designed the platform from the ground up so that, you know, it works within that Medicare Medicaid environment in terms of price point. And we did that by building a really truly intuitive platform that clinicians can use without, you know, a lot of training or ongoing support and maintenance, which keeps our margins high, our operating costs low. But, you know, one of the most unique things about us is the patient experience we deliver. So, you know, the patient might have a device in their home, it'll have an audio component, it will continue to provide daily reminders in the patient's language of choice. So it's a very, for the patient, low-tech experience. They don't have to use an app on a phone or a tablet or a desktop computer interface. You know, it's just go over there, prick my finger like I've been doing, you know, since I was first diagnosed with diabetes, or step on a scale, and the data immediately uploads to our platform. So, you know, if you look at any other sort of competitive company, their whole website is just pictures of, you know, seniors holding smartphones and using apps, and that's a very small
fantasy world. Yeah,
it's a very small percentage of the overall market. You know, these are patients with in some cases, memory issues, visual acuity issues, language issues, sometimes literacy issues, connectivity issues. So we set out to serve the most challenging patient population. You know, we started out with just Medicaid patients, so people living below the poverty level, and, you know, really challenging patient population.
And those are the people that need this the most, really. So it's like, it's
also where the budget's going to go going forward. You know, Medicare and Medicaid have expanded their budget significantly since we first started. And the reason for that is that they see that, you know, an upfront investment of, you know, $100 billion is going to save them tens of trillions over the years by keeping these patients out of hospital. We've demonstrated that our platform has that efficacy. And so the moat around our company right now, if other competitors do enter into the market, is that we've got 3 years of solid clinical data showing that we can reduce hospitalizations by well over 90% in patients on our platform, and that our clinicians consistently receive reimbursement from Medicare and Medicaid. And I think that reimbursement track record especially is what's really been driving a lot of the inbound sales that we've been having.
You know, it's a key thing. I mean, listen, the money is the motivator. People, you know, this is it's really what you have set up. Really, this kind of system. It's a win-win for everybody, for the patients, for the doctors. They're able to make money, and the insurance companies, because they're able to save on taking that big hit from, you know, major hospitalization. So they don't want, instead of paying out 500 grand or whatever, you know, they spend a couple of grand a year, and that saves that for okay.
Yeah, and it's great for patients. I know sometimes in the, you know, financial equations that patients get kind of ignored, but, you know, it has a life-changing impact on patients. In some cases, it's life-saving. So we can notice and alert clinicians if patients forget to take their medications and have a dangerous drop in blood pressure, or if they, in that case, it's usually they've doubled up on their medications. But we can prevent, you know, strokes and heart attacks, but more than that, what we really do is give these patients much better quality of life for the last 1 or 2 decades of their lives. And that has a follow-on effect, you know, much less of a burden on their families. You know, it's a very positive thing that we're doing from sort of a social aspect. We're just, you know, in a very good position right now where that also translates to significant financial incentives and gains.
Yeah, no, it's a, you know, really a great situation. Now, one thing I want to, which we should clarify, is this. You know, I'm sorry, I start off with this number that, okay, you got the 200,000, the contracts, okay, but really the focus is not, okay, those are the, but people, I think what people need to understand is you haven't just stopped with those 200,000. You're adding a new market, new verticals, yeah. And you're just, I mean, every couple of weeks you've been putting out announcements with new contracts. You're entering, you just, this week you entered a new market, which is the HIV patient monitoring market. So let's kind of dive into that, and we'll talk about some of the new markets. You know, like this is a kind of a new, is this a new vertical, like the HIV market? Like there's other verticals you can do?
Yeah, no, it's definitely a new vertical for us. You know, and I think that's one of the big positives about our platform is that we are extremely flexible, so we can very quickly add new clinical indications. The one thing physicians hate more than anything else is having to go to more than one platform for access to patient data. So they do not want to have to log on to a device-specific platform to see their diabetes patients' data, and a different platform to see how their dementia patients are doing, or their patients on chemotherapy, or their patients with mental health issues, or with opioid addictions. And so if you use our platform, because we can plug into, connect to kidney dialysis machines and CPAP machines for patients with sleep apnea, and we have the watch and the pendant for patients who have, are at a high risk of falls or have memory issues, dementia. And, we really offer clinicians that, sort of one-stop place where they can get all of the data on all of their patients. And it does a lot of that automated triaging for them. And so as Medicare and Medicaid continue to expand the codes that allow for virtual care for different patient populations, we're able to quickly step in. So with the HIV clinics, and there's a lot of stigma still around HIV, which was a little bit of a surprise and definitely a huge disappointment to me in this day and age. But a lot of the HIV patients won't go to a primary care physician or an urgent care clinic, or they will only go to HIV specialist clinics and for all of their health care. And so, those clinics approached us and said, this seems like a great way for us to expand our revenue streams. We tend to operate at very, very low.
People haven't, people haven't talked about HIV in because apparently, in years, but there's still, there's how many patients in the US, let's say, how big is the patient?
Yeah, luckily it's not an enormous percentage of the population, but there's 1.2 million patients, and a lot of those patients are now older, they're elderly, and HIV patients tend to have the same age-related illnesses the rest of us have, but they start earlier, and the impact is more significant in HIV patients. So remote monitoring really helps these patients, and it also gives them, the ability to have that virtual care where there's more privacy and anonymity, and they don't have to feel a sense of stigma, but there's that, kind of continuous, consistent, longitudinal care. So that they get better health outcomes because they're being followed by the same people over the long term and not just kind of bouncing from clinic to clinic. And I saw somebody was asking what else besides HIV. There's a lot of other sectors that are opening up to us. Just over the last year, we've really moved into the mental health sector. A lot of not just chronic disease patients, but just patients in general are coping with, especially during the pandemic, depression and anxiety. There's an epidemic of addictions, particularly with opioids in the US. And
how does that work? So how does this work with the mental health space? How does
mental health patients, what we really do is kind of care coordination between all of the different members of a patient's care team, so that, if they're seeing a social worker and a psychiatrist and a family doctor, primary care physician, and we're providing all of the information about that patient in one spot, so that they're not prescribing conflicting medications, and so that you don't are shopping around for multiple morphine prescriptions, for example, and it can help monitor medication adherence in the home for patients who, for example, might be on methadone or doing a taper off of opioids, or for patients who are at risk of addiction, have a history of addiction, and are at home recovering from surgery or an injury and have been given pain medication. It can monitor to make sure that they're taking that appropriately and not abusing the drug and giving themselves an issue again going forward. And so there's a lot of different things we do with the platform. In terms of just kind of the more conventional monitoring, there's a lot of new conditions we can monitor. Asthma is now covered, musculoskeletal issues. So, we can get into a whole bunch of different disease states there, high-risk pregnancy. So we can monitor, baby and mom at home. And I think, long-term, it's going to give us the ability to address, pregnant women who typically don't receive pre-delivery care because they're very, very busy working, and they, are living either in remote and rural communities or below the poverty level and have access to care challenges. And a lot of that, kind of monitoring and check-ins can be done virtually. And it's that kind of thing leads to fewer low birth weight babies, fewer complications. So there's a lot of clinical indications out there, and a lot of what they call sort of behavioral issues that can be managed through the platform.
So the projections you made, the projections that are out there in the market, which is this 200,000 patients, which will be onboarded. Mm-hmm. Again, that's only the existing contracts that were signed. It's not the new stuff. It doesn't include new verticals or anything else.
Right.
So that's like backward looking a little bit, right? That's not even forward.
Yeah, I mean, that's definitely something that we developed earlier, and we obviously aren't stopping business development. And
so in theory, you could have 500,000 patients.
Yeah, no, I mean, I think
2023.
I want to make the point that we designed the platform to support millions of patients simultaneously. And that's our expectation, is that ultimately this platform will be hosting millions of patients. I think this is the future of healthcare. Not even just our platform, but this approach where it's more proactive, preventative. You're keeping these chronic disease patients out of the hospital where they do not need to be. These are preventable complications, and you're giving them much better quality of life. And so we're not just prolonging life, we're giving people good quality of life in those last few decades. And so, certainly what we've seen from Medicare and Medicaid, and this is echoed by analysts in the space, is a continued emphasis on expanding virtual care programs, expanding preventive and proactive, preventative care for specifically the chronic disease patient population. And so I think, that's a trend that will continue. And as a result, obviously we expect our growth to continue to be very, very rapid for, the foreseeable future. So, many years, not just, the next 18 to 24 months. And we continue to add new clients all the time. Sorry, go ahead.
I'm sorry about that. I kept put the focus on the 200 because that's kind of, I look at that as, okay, this is the thing that's very important. But at the same time, you have this, the growth is just it's the snowballs keeps going. Like for example, was it 2 weeks ago, you added, 6 more clinics, 6 more contracts you have. So, and what's interesting, I should add, is that, our whole approach, the premise with, our platform, the next super stock platform is we say to investors, look, we're going to bring you these companies right when they're at that inflection point so that that, okay, as soon as they show up, that means that, okay, there's going to be a news flow, there's going to be, new deals, revenues, and such. And I got to say, not everybody has delivered. Reliq has delivered. Basically, it's right out of the gate. You signed up, I think, in March. What was it? And it's the contracts have come out, the profitability, everything. Basically, you've delivered on everything that you have promised, which I think is very, it's very important, especially in the microcap space.
Yeah, I mean, I think we I always hear celebrities talk about an overnight success, but they've been working for
30 years, right?
We're similar. I think we worked really hard for a lot of years to get to this point.
But you're not even there yet. It's going to be there in a year from now, 6 months from now. This stock is just getting kind of started here.
Yeah, and I mean, we do, we definitely still have our skeptics, and I always say to them, look, I'm not raising money, so I don't care where the share price is right now. So if you want to wait until we publish Q3 and Q4 calendar results and see where, that we're delivering, absolutely do that. You are going to pay more for the stock at that point, but you have to manage your own risk tolerance profile. So we get a lot of people who want kind of that upside, but with guarantees, and those don't exist in the stock market, unfortunately. I wish they did. Then I would certainly invest in those. Although I will say everything I own is invested in this company, and I'm very happy with that investment. But I think we're a company that definitely is at a point where, we're executing consistently, and I'm really comfortable with the guidance we've provided. And I'm really looking forward to the next, several quarters where we really are able to show people definitively, quantitatively, that we're delivering on what we're saying. Someone I saw asked about how onboarding is going. I think we've talked a little bit about how by the end of the year, the revenue projections translate to 40,000 patients on the platform, and we are absolutely on track to hit that metric. Onboarding is going very well, and so we're very pleased with that. And I expect the onboarding pace will pick up really dramatically next year, as we start to bring on some of the larger clients that we have implementation plans with, who kind of needed about a year to recover from COVID and, figure out how they're going to move forward, especially if COVID's going to be around for a while.
Yeah, it's going to be around forever. I mean, they're coming out with this new variant, the Lambda variant, this is going to be. Yeah. Which also, by the way, apparently now it's actually going to help drive your business, because this, for the doctors, it's very compelling for them. It helps their revenues and everything else. So let's okay. We got a few minutes. We're a little late. Hopefully, we can answer just a few. Are you? Sure. I think also you have to leave, right? But we have to.
I'm okay. I'm good.
Okay. let's see if we can answer a few audience questions, and then we'll wrap up. Okay, so there was a question about NASDAQ. Lisa, before you answer, I know you're talking about NASDAQ. I think you should stay away from NASDAQ as long as possible until the stock is really like, trading massive. Don't do any reverse splits. Let it stay like, don't do reverse splits. You want to keep the thing so more liquidity and,
Yeah, no, I mean, I talked to Oppenheimer about this, and they were saying, do not do a reverse split. It's really important that institutions feel there are larger blocks available for them to come in and establish significant positions. So, I tend not to worry too much about that whole.
The stock will take care of itself. I mean, we've had companies that do these reverse splits, and for NASDAQ, it doesn't always work out as like it's best let it go organically, and maybe. Yeah, I mean, listen, when the stock gets to $10, maybe you could do a split, a 1 for 10 split.
Right. I mean, we'll think about those things when the time comes. But I'm a big opponent of that kind of financial engineering just for financial engineering's sake. So, if it makes sense for the company, makes sense for the shareholders, we'll do things, but we're not going to do them arbitrarily to try to, inflate share prices or make people who get hung up on share count happy. We're focused. We don't spend, I like to try to, spend as much time as I can on our investors, but our focus right now is really clients because we're growing so fast. So, that translates to a lot of benefits for shareholders, because if we focus on our clients and, continue to get this kind of growth rate, everybody wins from that. So, that really is where the company focuses most of its energy is on actual operations and not so much, how do we make the capital markets work for us? I think, I'm not saying
it's very refreshing, very refreshing.
Communicate to the market, and we do try to be good about that. Okay.
This is the last question. Okay, so Lisa, thank you for releasing the news when you guys hit the profitability. Okay, could you shed light on the upcoming quarter revenue numbers? Would it be 2.5 times what you had? 5?
I actually. I'm not super focused on what the numbers are per quarter, so I can't do that math in my head right now, although I'm very, very good at math, but I just don't have those numbers at my fingertips. What I really want to focus on is the revenue run rates, because those are what matter going forward. The revenue per quarter, obviously it's important to me because it helps fund the business and important to shareholders. But the most important thing, for shareholders going forward is the revenue run rate that we're achieving. So, initially there'll be some lag in the revenue that you receive. But if we hit, as we will by the end of this quarter, a revenue run rate of 3 million, doubling the run rate from the end of last quarter, and then 6 million by the end of the year, that's really substantive growth. If it takes a little while for the revenues to catch up, because there's 30 days on receivables and things like that, that's not really a big issue for us. We do have more than enough cash right now on hand for funding our growth going forward. But what really is going to drive interest in the company from the institutional side, which, getting the institutions, especially the U.S. institutions who really understand this market, getting them and their support into the company reduces a lot of that volatility, which I think benefits all shareholders, institutional and retail. But what we're really hearing from the analysts and the institutions is, it's that revenue run rate that matters. And, so those are the numbers that I tend to focus on in our
the run rate. Yeah, they want to see the run. Okay, so one thing, I want to ask one last question here, and actually 2 last questions. So the one last question, again, for the big fear of Canadian investors is, okay, is the company going to do a capital raise? And, the stock has been moving up now, so they're worried, okay, let's say the stock goes to $2 in a month, are you going to do a $10 million raise? So, I mean, is that off the table?
Yeah, that's off the table. And I mean, if we did do a $10 million raise at $2, that would have very little impact. That would be very, minorly dilutive. And, you have to keep in mind, you're getting that 10 million in. So you're increasing the value of the company inherently, plus fueling growth. But I mean, as I think I've said this several times, if we decided to do a raise, it would only be because we had a very, very large client, much larger than we'd anticipated, who wanted to move much more quickly than we'd anticipated, a new client, so new numbers to add. And then we'd be looking at a $3 to $5 million raise tops. And that be really this fall. After that, once we get into Q1 of next year, we're throwing off enough free cash on our own that, however large a client and however quickly we want to be able to respond, we'd be able to fund that ourselves out of our own profits. So, the bottom line is we have no intent at this point of raising capital, but if we did, it would be a tiny amount, and it would be in response to exceptionally good news. So, at that point, I don't think dilution would be any kind of a concern.
So in other words, if you signed up a major client, which would require, whatever, I guess it would have to be something really substantial, then you might raise, 5 million roughly.
Yeah, I mean, if we had a client who said, I want to put 100,000 patients on the platform in the next few months, we might raise a little bit of capital to allow us to respond quickly in the fall.
But that would also mean, but if they want 100,000 patients in the next few months, that also means that that's roughly 50 million revenues?
60 million annual.
60 million. So I think investors wouldn't mind that if you could pick up 60 million revenues to sell a couple of shares here. It's not a big deal.
Yeah, and I mean, obviously, we'd be looking at being at a higher valuation at any point that we would consider raising money, but it's not, it's not our plan, and
Oh, our internet is frozen. Okay. Okay, stand by or. Okay, internet problems. Okay, I think it's on. Okay. What is going on with the internet today? Oh, okay. So okay. All right. Okay. Let's see if we can get Lisa back on. Lisa.
Yep. Sorry.
Lisa. Okay. Sorry, we lost you. We lost you there for a second. Okay. So to wrap up, I think we were talking about the so capital. So basically, you wouldn't do any capital raise unless you had somebody a major client that would want like 100,000 people, which would generate 50 million revenues roughly, and then you would do something, a small raise.
Then we'd consider it, but it's not something that we're contemplating really at this point. We're doing very well. Onboarding's going very quickly. We get a ton of inbound sales every day, so we expect to be able to support the growth we have right now. I'm a chemical engineer by training, and so I tend to be very conservative, and so I like to spell out all of the possible paths forward for our shareholders. Really quickly about collectability, that's improving vastly. We did give our clients a lot of flexibility around payment, so we really were very flexible with payment terms during COVID, but there's not really that need anymore. I will say that also some of our vendors were flexible with us during COVID about payments. That's all behind us now. We're fully caught up on all of our payments, and our clients are getting very close to fully caught up. So receivables are going well. I mean, I think because we've introduced the ability, in 2019 and 2020, we built in the ability to secure electronic pre-authorizations from Medicare and Medicaid for patients on our platform, and before we did anything with those patients, and because we help clinicians through electronic claim submission, and the collectability is much faster.
Okay. Let's see. Okay. So Lisa, on that note, and this is the last question, absolutely last question. Okay. What else can investors, what kind of news flow can we expect over the next 30 days? We're already at the end of August into September. What can we look forward to?
Yeah, I think you're frozen. I hope I'm not frozen. I think investors can definitely expect to see continued growth and a lot of continued news flow for us. And we are working with our investment bankers on that NASDAQ listing. So, we will be starting to make some progress there that we'll be able to, update the market on as it happens. But, I think that companies in the position we've been aiming to be in for 5 years, where we've really built a solid, credible product, and, we've got the right team in place, and we've got the customer traction. In healthcare, that is very autocatalytic. So, we're very happy with where we are right now.
Okay, but in terms of, okay, so the NASDAQ listing, though, that's not something that's, that's kind of, you're just getting things kind of teed up so that, right. 6 months from now, it's not like,
no, we want to make sure that when we go onto the NASDAQ that, we will attract attention there. So we don't want to, graduate to the NASDAQ too early, or you just kind of.
I completely agree. You don't want to be like you don't want to be a small fish in a big pond. Like right now,
Exactly.
if the stock starts moving, everything, you're going to be a big fish in the Canadian pond. So you want to go with momentum. So so essentially, I don't, and also we don't want people to like start speculating. Oh, the NASDAQ thing is going to happen in 30 days, 60.
No,
this is 6 to 9 months out minimum.
Right, exactly. That's exactly the horizon. But I do think that when it's the right time, that's the right exchange for us, and I think that will go well. I think we're a careful company, and so we don't like to do things too quickly or too early, even though you do get a lot of people urging you to do that. So we'll graduate to the NASDAQ at the right time, and you do see certainly generally an appreciation in valuation when you make that move, but you do want to time it right.
Yeah, that's no, I appreciate that you understand that, because it's like, yeah, we've had issues. Companies sometimes they jump. It is absolutely, there's no question. NASDAQ, it's the ideal environment where you're going to get the value, because NASDAQ loves these companies. You're a U.S. business is mostly, but like you want to do it like really when things are ready, like not too early.
Right. When people will get excited about you being on the NASDAQ, not just see you as one of those teeny little companies that graduated to generate some excitement, but are really not quite ready there.
Right. But in the meanwhile, I think listen, by the time you do get there's the stock, there's plenty of upside in the stock in terms of this, a lot of catalysts and everything that for the value to show up. Okay, so Lisa, thank you on that note. I'll catch you up on the next live stream. Thank you again.
Great. Thanks everyone. Thanks so much for joining.
Okay. All right. Great news at RHT. Let's get ready for our next exciting presenter. Let me just correct one little thing. Let me just change this banner up. Okay. And let's see if we have Brent.
Jack.
Okay, you there?
The next exciting presenter.
Brent, thank you for your patience. We ran a little bit late. Sorry about that.
No,
it's definitely going to be worth it for everybody who's here.
Yeah, frankly I enjoy watching it because last time I got to see Sean, and this time I got to hear part of Lisa's story, which is quite interesting. So yeah, it's nice to be backstage during that.
It's interesting. Well, listen, there's a lot of commonalities kind of where you're at, where, like Reliq. There's like sometimes, investors that they expect, massive results like immediately. And it doesn't happen that way. It takes a little while for it to develop. And then all of a sudden, then the stock explodes. I mean, we see this happen over and over and over. I mean, listen, your background is on Wall Street, so you understand what I'm talking about, right?
Yeah. I mean, we could actually. Are we live now?
We're live. I'll do the intro in this. Actually, I should do the intro because we're kind of running late. So
yeah, sure. Because there was something I was actually going to bring up. I just had an interesting conversation about the stock side, which I think some of our viewers might find interesting. So yeah.
Okay. Okay. Hey, you know what? Actually, we're already live, so let's just talk about it.
Okay. Cool.
I'll do the intro in a second.
Yeah. So how would you like to start? I mean, I'm happy to. Start with what I was about to say, or we can
continue, Brett. Yeah, continue.
Yeah. So I obviously take a lot of calls and emails and text messages because my contact information is out there, and frankly, I enjoy it within reason, and if I can hopefully respond to everyone. But I've gotten a lot of questions since the IPO about why hasn't the stock performed better. Why has it not gone up more? Because we're on an exchange. And I had an interesting conversation right before I got on here with you. Some of it I already realized or was familiar with. But what I can say on the positive side is that we've had a big increase in requests for information, requests for interviews, requests for virtual meetings with both institutions and individuals. Institutions, individuals, and wealth managers in Canada. So that's stepped up a lot. I think if one looks at the volume on a daily basis on the NEO, that's stepped up nicely too since the IPO. where's the selling coming from? Well, and I hope I'm not blowing anyone's cover here, but typically when smaller IPOs get done, both in the U.S. and in Canada, there are participants that are funds that have a very specific strategy, and that specific strategy, I would say, probably doesn't resonate with your audience, doesn't with me, but I understand the rationale behind it. So these funds, they participate in the IPO, they get the warrants, they sell the stock at or near the IPO price. Those are called warrant strippers. Then they hold the warrants, they exercise them as soon as they're in the money, and then they subsequently sell those too. So I did the calculations because we've had some warrant exercises this past week. These folks are making 4 to 7%.
Yeah, it's risk-free, basically.
Yeah, it's great. For them. I have
how many warrants are still left to be exercised, do you think, from the IPO?
About half.
Okay, so it's pretty good. Okay.
Look, I mean, look, we raise additional funding from it, which is always a good thing. But the good thing is when you get them out of the way, they're no longer. It's no longer.
I think that's going to be one of the catalysts for the stock to be moving forward. So actually, my timing for my whole interview, my intro is all screwed up because we got this.
Sorry.
So I'm just going to post this onto as is. But okay. So bottom line, for anybody just tuning in, look, our goal with the Wall Street Reporter's next super stock live stream is to bring you those stocks which have that 10x to 100x upside. As you heard before, we've had already 7 of those in 18 months. 7 stocks increase between 1,000 or 1,200% and 5,000%, 50x. All these companies have 3 things in common. 1, going after multi-billion-dollar market opportunities. 2, at a key inflection point, and multiple catalysts that are built in, which could ignite massive increases in the stock price. And of course, Logiq has all 3. Otherwise, Brent, you would not be here. The things are starting to come into focus. So the stock, again, for anybody that for the first time, if they're watching this for the first time, so you joined our platform last year. Stock was about $3.50. Shortly thereafter, it started running to $14. The Canadian financing came in. The Canadian financing kind of derailed things, and the NEO listing kind of derailed the stock price for a couple of months. So the pain, I think we're pretty much done with the pain at this point, and the childbirth is basically over. Now we just have the baby, this is going to be this is like a baby unicorn, which is ready to start going back to 10x, 100x, etc. So I want to focus on a couple things, right, which I think investors are interested in. One of the big ideas is that you talked about that you want to get to a run rate of about 100 million revenues the next 12 months or so through acquisitions, organic. Your quarterly results come out, which are helping you move towards that. So things are progressing. So let's kind of recap the idea of like what's going to take to get Logiq to that 100 million revenues, because that would essentially equate to $1 billion plus valuation if you get the same valuation as your peers, or more, 2 billion maybe. That's true. I think a couple of things to look at are what we did last year during COVID, and I think that's a very critical view that investors have taken and should take, because companies that can successfully navigate times of challenge or calamity generally fare very well when markets are much better. Now, one of the things that we decided to do last year, as COVID was literally at its peak, or heading towards its peak, was get very aggressive around our strategy and going forward. What could we do to have a better product and service mix? What could we do to expand the platform and our product offerings? And
going forward from that time, each time we had a conference call, we spoke at length about those plans. And then in hindsight, we are now able to point to each one of those conference calls. We just had one this past Monday, which I encouraged our viewers to watch when I was on last week. Listen to when I was on last week. And I think paying particular attention to things we've said that we've executed on from a corporate level should drive people towards a decision in regards to our stock. We've talked about increasing margins, and we have increased margins by well over 100% in a year's time. That's
been one of the big issues. I think that's what, in terms of like bigger like institutions, those guys. I mean, they're. I should add that, look, a lot of the companies we deal with, they don't really have very minimal revenues or still in the development stage. You're actually, you're already, what do you have, 38, 40 million run rate. So people at this point, investors, they're looking at the margins. They want to see, okay, what are the profit margins? The revenues is not enough. So, and now your gross margins, I think for this quarter were 29%, right?
That's correct. That's correct. And we've stated that our goal is to exit the year above 30. More importantly, the data Logiq platform that we've launched recently that encompasses all three acquisitions we've made in the past year. And again, that was part of the strategy during COVID. Get aggressive around acquiring IP and tech to make our platform more compelling to potential customers and more interesting and functional for existing ones, which we've done. And if you look at the revenue, the margin profile of what we can do with the recently launched Logiq digital marketing segment, that carries 60 to 70% gross margins. So as that business starts to ramp, our consolidated margins obviously increase. Plus, any M&A that we bring on that fits into that sphere will either already carry those types of margins or would benefit from that blended margin profile. So, we've, as I've said the past two live streams with you, we're very serious about M&A. We certainly have a full pipeline. There are things that we're under NDA with right now. It would not be out of the question to see some forward movement relatively soon, because that's just how we're carrying on. And when you do, I think it's going to just further drive home the point that we're intent upon continuing to expand margins and grow revenue both organically and then through M&A. So
the margin really, I think, the big question a lot of people are asking, okay, why is Logiq only trading at 1.5, 2 times revenues, when the peers are trading at 10 times revenues? And the answer has been basically because the margins were considered to be low, but now your margins are increasing to the same level as those peers. Ergo, you should have the same type of revenue multiples of 10x plus.
That's correct. I think the short answer.
That's the catalyst, basically. Once those margins, keep going up, that's going to be the big catalyst. I think that's going to get you to 10x. That
justifies it for sure. I think the real key component is, how do you market yourself as a company? Because with tens of thousands of companies that are publicly traded out there, you get lost. And so how do you do that? Well, certainly formats like this, other similar ones, getting more aggressive on investor relations, getting in front of more institutions and investors through virtual roadshows, strategic digital marketing, showing up in trade publications, getting what's called thought leadership out there, where our other executives are interviewed in industry publications. So just pushing the brand.
More visibility is definitely going to help. But okay, so the data Logiq business, I think this is the big thing. This is where, so the way I look at it, there's a couple of catalysts for the stock, for value to be created. The data Logiq business, which is, I guess we have to explain what that is for anybody that doesn't know, which is the ad tech marketing business. As that business is growing organically, which, the growth is really increasing. You are going to have M&A, and the other thing is we should talk about later. At the end is the potential spin out of the Indonesia business, the fintech e-com business there, which could be worth more than the current value of the stock. But let's save that for last. Let's talk about the data logic side first, right? So
Sure.
the Indonesia business is really the app logic, right? That's the app logic business.
That's part of the app logic business.
So data logic, what is data logic? Give us kind of the overall picture. Like what is it? What are you doing? What is
Sure.
that?
Okay. Yeah. All right. So it is a platform that small to medium size e-commerce companies use to buy advertising online. And I'm simplifying it quite a bit. I mean, there are multiple components of it. But very simply put, if you are an e-commerce shop, and I just read this morning, actually, there's 23 million e-commerce stores globally. Of those, there's about 600,000 that do more than $1,000 a month in business. So it's there's a ton of
market.
Yeah, so you've got 650,000 of them around the world that do more than $1,000 a month in business. But the top five account for 53% of the entire e-commerce market. So just five. Amazon, Alibaba, Home Depot, Zappos. I mean, literally half of the e-commerce market is controlled by five companies. So what does that mean? I think for most investors, it doesn't really mean a lot. And maybe it means go and buy the stocks of those companies. But what it means for the other 600,000 companies that compete with them in various sectors, it's, gosh, these giant companies have a ton of money to spend on advertising. And in any market, when you're competing against those types of ad budgets, what happens? You usually get crushed, or your business doesn't grow as well. So what do you do? Well, there's not a lot you can do because the company that specializes in enabling the whole ad tech purchase is a company called the Trade Desk, TTD. It's an NYSE listed company, massive market cap, massive valuation, but they've got a $100 million per month ad budget minimum.
100 million a month. What?
Yeah, 100 million a month. You have to spend in advertising to become a client of theirs.
Okay, well.
Yeah, so that basically rules out a ton of companies. Yeah. But as part of our strategic roadmap, it's okay. How do you capture the market of all of the rest of those companies that may have 10,000 a month or 100,000?
I think we should also add. So, Brent, I think you should also add essentially. You essentially enable e-commerce. So the ad tech, that's one part of it. You also have different AI tools, optimization tools, to optimize the whole e-commerce, the traffic and everything else. So it's
that's right.
A full suite. It's not just limited to.
That's right.
Buy ads on Google or something.
I'm oversimplifying. I mean, because it's not all about Google or Facebook. By no stretch. I mean, it's finding ad placement on CNN, on Forbes, on look. It gets as granular as wanting to run ads on formats like this. So, who's your audience? Well, it's investors looking for microcap stocks. They tune in here when this live stream is on YouTube. Being able to place an ad on that site at the time that someone is looking at that is quite critical. If you're a small company that has trading analytics software, for example, that's exactly the customer base that you want to get in front of. So how do you do that? You're right. It's AI tools. It's a number.
So here's the cost. Okay, so in theory, somebody can just go on YouTube and buy the ad. So what would they gain by going through your platform?
Okay, well, it's you're right. You can do that, but generally, what small businesses do is they say, okay, this is what I'm selling. I'm selling, call it solar panels, for example. What demographic do I want to go after? Okay, it's males between the age of 35 to 50 who live in these zip codes. or drive this type of vehicle. Okay, call it an SUV. What type of keywords do I want to buy? You know, you think of the obvious ones: solar panels, SUV owners. The obvious stuff is also the obvious stuff that Amazon and Home Depot and all the big guys are buying, and they can outbid you, because it's all bidding. It's not, okay, I want that ad, I pay for it. You bid against other people, so it's whomever is willing to pay the higher price.
Your platform helps your customers essentially outsmart or find niches or optimize. Essentially, by using your platform, they're going to increase their revenues, and they're also going to decrease their ad costs.
Well, one before the other.
Okay.
Yeah. Okay. So, all right. So expanding upon what I was describing earlier, you think of a certain demographic that might be the demographic, or those may be the traits that a company can identify with past purchasers. Okay. Or maybe their advisor or their ad agency is saying, okay, males between the age of 35 and 50, SUV owners, they live in these zip codes. But everyone else that competes in their space is thinking the exact same thing and bidding on the exact same thing. So the workaround is that you use our platform. It has AI tools, okay, but it also looks at 200 different other categories, all right, that buyers or historical buyers of similar products have. So it may not, all right, so it may not just be males between the age of 35 to 50 that drive SUVs and live in this zip code. They may be pet owners, all right? They may also be sports fans of a certain team. I mean, there are other attributes. They may own a Samsung mobile phone. There are other things to look at that fit into that demographic, where you can actually go and purchase ad space with those demographics instead of paying up for the ones that are the obvious ones. Does that make sense?
Yeah, completely.
And if you think about it, I mean, and we don't trumpet this, but the things that we find out about an individual when compiling a profile are in excess of 200 things. But we know everything from not only the zip code, but your address, how much money you make, what kind of cars you drive, how many digital devices you have, what sites do you visit on those devices, what routes do you take to work. I mean, there's a whole host of information that is it's the Big Brother thing. But what does that mean? I mean, why am I talking about it? Okay, well, because companies that are interested in selling things need that information to better target the customers that are not the likely candidates that they would be looking for to buy ad space to get in front of. And so that's what, leveling the playing field comes in more forms than just competing for the usual AdWords or the usual demographics. It's being savvy enough through digital means, artificial intelligence, to tell you what you can show your customer, the other demographics that they can go after that are cheaper to acquire and still get the same types of leads or audience.
Okay. So that business is doing so that's the DataLogiq business. How many companies? So you have how many companies? Has a couple of components. You have what are the different companies that you have inside of DataLogiq? The different.
Okay. All right. Sure. Let me just digress for a second in case anyone's not familiar with Logiq as a whole. So there's Logiq, and then there's AppLogiq and DataLogiq. Within AppLogiq, we have three segments there: Create App, Pay Logic, and Go Logic. That's where we started 6 years ago. When we started the evolution of DataLogiq, we started with, I won't go through the older names, but the current business segments are branded as consumer marketing, which is Push that we acquired last year, and then Logiq Digital Marketing, which is a combination of Fixel and Rebel that we just acquired last fall and then 2 months ago. So within DataLogiq, it's consumer marketing and Logiq Digital Marketing.
Okay. So the DataLogiq side that's where the big margins are. And that's also where you've made acquisitions in the last year this Fixel, Rebel, and you have some more in the pipeline, basically.
We do. We sure do. But a little bit of a different profile. I mean, there were revenues that came when we acquired Push last January. And that's been great. I mean, when we acquired them, they were averaging about $500,000 a month in revenue. This past quarter, that came out to nearly $2 million per month in revenue. So they've done a tremendous job. Margins have doubled there as well. But Fixel and Rebel, those were not revenue accretive. Those were to acquire IP and technology. Going forward, we intend to make acquisitions of companies with accretive revenue and earnings. And frankly, we've seen some that are actually profitable too. So there's a lot of very compelling privately held companies that would be a tremendous fit that we could pick up for valuations similar to ours, whereas the averages are 20 plus.
And the space it's very fragmented. I mean, there's like thousands of companies in this kind of ad tech marketing technology space that they all. I mean, there's so many companies that provide various niche type services that either help you buy ads or optimize things or what automation, AI. Well, there's a whole. It's the whole. They're all more like the SaaS, business model. So you have a lot of opportunity there.
It's crowded, and it's hard. It's hard as an investor to determine what segment of that you go after, and it's a lot to get one's arms around. I think trying to keep it as simple as possible, go with things that or things that you can come to know through a simplistic explanation and understanding. Yeah.
And okay, so that's okay. So that's the data logic side. Now, I think one of the key catalysts, which we haven't really talked that much about, is the potential spin out of kind of the Indonesia assets, the AppLogic Indonesia assets. So, give us a little bit of a snapshot Indonesia and do you have that? Are there plans to spin this out, or what's the plan to kind of?
Yeah, there absolutely are. Unfortunately, we've been talking about it for some time, but with that, I am quite certain that on past interviews, I have said that there are currently just one or two. Actually, there was only one other publicly traded company that has a specific Southeast Asia, Indonesia focus that's in tech, and that's SE. From the time I've been on here in the past, it's been a year now. Their stock's gone from about 60 to 310.
Yeah, this is
massive. Yeah, but I also said that there will be others. I specifically said sometime in the next year, you'll start to see these unicorn valued companies that are backed by a who's who of private equity and VC and strategics coming public here. And 2 months ago, it started. We had Grab, based out of Singapore, but focused in Indonesia. It's the equivalent of Uber there. They just announced that they're going into a U.S. listed SPAC, $45 billion market value. 2 weeks ago, FinXL, a fintech company in Singapore with a focus around Indonesia and other neighboring countries, is going into a U.S. listed SPAC for a $2.5 billion valuation. And then there was an IPO also 2 weeks ago called Bukalapak. It's only in Jakarta now, but they have plans to list an ADR here, $6.5 billion IPO. And these are all US dollars. So what does that mean? Well, the valuations are exactly as I described, big US style valuations, tech companies focus around Indonesia, opportunities for institutional and individual investors here to participate in the growth of the hottest emerging market in the world. Okay, we have that element? Yeah, it is our ownership of our Indonesia business, which comprises an e-wallet, a hyper-local food delivery business, and most recently microloans. And so what does that mean? Well, that means that there's an equal opportunity to participate in that. But given the fact that that's been carried on our balance sheet and we have not had the ability to extract value, has made it a bit challenging. So how do you do that? Well, there's two ways. You either sell the stake to someone else and then distribute the proceeds to Logiq shareholders, or you spin it off in the form of a dividend to shareholders after you've taken it public. So, and there's two parts of going public. You either take it through an IPO. It's a little too small to do that, but you could certainly go into a SPAC. You could certainly merge with 1 to 2 strategic partners and go into a SPAC. And are there SPACs around? There are. And have we been talking to them? We did state on our call the other day that we are in discussions. So I'm not telling anyone anything that's secret, but this is something we've been working on for a long time. I think you're going to see it come to fruition in the midst of these other unicorn valued companies coming public here in the States. I think it's going to generate a lot of interest, and not only from investors, it also from potential investors on the strategic side that do not have a presence in Southeast Asia now. How do you get that presence? Well, you make a strategic investment or you buy someone who is.
Yeah. So the the potential spin out of the Indonesia asset. I mean I think that'll be that could be worth more than the entire value of Logiq right now. I mean, as a standalone company. Because you have this, you have two things. You got the fintech side, your food delivery, the e-commerce side, and you talk about SC, but also the Alibaba. I think on one of their earnings calls, the CEO was saying that they see Indonesia as one of the last big opportunities in Asia that's still remaining. One of the last big market opportunities, and it's with 300 million people, massive market.
Yep, that's exactly right. Alibaba is one of the largest investors in, maybe a dozen or so privately held companies there, and they're also an investor in Grab. Well, I may be mistaken. They're either an investor in Grab, which is the one that I mentioned earlier that has a $45 billion valuation, or they're an investor in Logiq, which is merging with another company, and they will also be coming public in the next month here in the U.S. for evaluation.
Yeah, there's going to be okay. So basically, the U.S. investors, a lot of them don't even know where Indonesia is. But now that this is going to be getting a lot of attention with some of these hot IPOs and everything else, that's going to bring a lot of eyeballs to the space, and so I mean the timing could be really good. I mean, over the next 6 months for this. It
is. It's hard to ignore. It's hard to ignore an emerging market when you see companies coming public that carry big valuations and are supported by tier 1 investment banks. They're supported by tier 1 strategic investors and PE funds. I mean, you can't shoot any holes in it. There's really no way to do so. You can't say, oh, these are fly-by-night operations. There's no validity. How do you support the valuations? You cannot poke any holes in it. Look, and I'm not saying that we are a competitor to any of these, but what we've set out to do is establish a foothold to where we have a presence, we have a footprint, we've got business in a demographic area or a niche that we've pursued that would absolutely enable a large or medium-sized foreign competitor to come into the market by way of acquiring us, investing in us, or partnering with us. So from the beginning, that's where we set out to go. And so, even if we don't go through an IPO or a SPAC listing valued at $1 billion, it doesn't matter. We're going to be part of something that will eventually be of that value because we're already there, and there's enough interest in the region.
Okay, no, so that's something that I think that's one of the kind of built-in catalysts in the stock right now. I think. Let's get to some audience questions. So Kevin is asking, when is Logiq expecting to see the full results of the integration and synergies from the acquisitions you've made? Push, Pixel, and Rebel. That's in the data Logiq business.
Yeah, sure. Thanks, Kevin. Integration, we acquired Rebel in April. It took an entire month to integrate them with Push and Pixel. I say that tongue in cheek, but it's that was actually above our expectations. We thought it'd probably take a quarter, but they finished it in a month, to the point where we started going after new customers in the form of ad agencies, and we've already signed up 12 the first month of marketing to them, and so now we are in full business development mode. So we're going after clients, fully integrated. You'll start to see that come online. Probably, I think the trajectory that it takes is when you sign up a new customer in the form of an ad agency, they start to onboard their customers gradually, who are in turn brands that buy ad space and use these tools. And then as that increases, then you start to see the revenue flow through. So I think reasonably, you'll probably start to see an impact as we exit the year. But again, the margins from that platform are in excess of 60% on that business, which is why it's so interesting.
Okay. Michael Martin, have you filed an S1?
Have we filed an S1? No, we have not. We have an S3 shelf. We do not need to file an S1, and I'm guessing that this has to do with an impending listing on either the New York Stock Exchange or NASDAQ. It can be accomplished through either our existing S3 or a revised one.
Okay. Oh, so one of the things that we should add is, for anybody that might be coming in new, is the reason why you went onto the Neo Exchange. There was a couple of thoughts. One is, ultimately, you want to get listed either New York Stock Exchange or NASDAQ, right? That was the goal last year. And, one of the ways to kind of speed up the process is, once you're on an exchange like Neo, they kind of have, I don't know if it's a reciprocal, but there's a relationship which makes it easier then to go on to, but also at the same time to open up to the Canadian market, which is actually very beneficial for finding stock.
Sure. Canada has always been interesting because from the beginning we always said that we're the Shopify of mobile, and where's Shopify from? They're from Canada, and there's probably a dozen or so e-commerce enablers or similar that have come out of Canada, and some of them have just been tremendous this past year. I mean, I talked about Lightspeed last time. They're Canadian. They're listed on Toronto as their primary exchange. Acuity Ads. There's a lot. So it's been a great market, and I think that fact alone has led us to have, as I mentioned earlier, a number of calls and interaction with investors since IPOing there. And yeah, you're right. There's a reciprocal relationship between global exchanges, and I can't say who, but there's only 2 exchanges in the U.S. One of them actually came to us and asked if we were interested in uplisting there, and so that would be next.
Okay, so that's one of the next. Okay, so by the way, one of the things I like about the Canadian listing is that at some point I think we're going to start to see this start to happen. Is, look, you have a lot of Canadian investors. Let's say they made money in Shopify, Lightspeed, Acuity Ads, any of these stocks that have been phenomenal. Now, as always happens, now they're looking for that next, stock that's going to be, a 10 bag or a 5x, whatever the number is. But they're looking for, that next one, and so. Because the Canadian listing, there's a lot of tax benefits to buy on a Canadian exchange versus in the U.S. in Canada. So that's going to be, I think, a positive. Okay, so there's potentially an uplisting still on NYSE or NASDAQ at some point. That's out there. You've already got Neo, so that's one one more up. What else is in the pipeline over the next, let's say, 3 to 6 months that you think could be a catalyst for value creation in this stock?
Wow, I think we've summed up the major.
A lot of them.
Yeah, look, we've clearly been talking about and executing on growth on the revenue and the margin side. We've clearly been talking about integrating the acquisitions we've made and marketing them as a whole, and we've started that. And we've clearly been talking about onboarding customers, which we've also done. I think that in addition to the things we've talked about. Actually, let me back up. Okay, so the catalysts are more institutional and retail exposure because we've IPO'd, clearing up this whole warrant exercise part in Canada, an uplisting, and a definitive LOI on spinning off the Indonesia business. I mean, those I think are more than enough. But and actually, some of your viewers have reached out to me about this. I think 2 interviews ago, I mentioned that we've been sitting on a lot of news during the quiet period leading up to the IPO. I got a little flack for this. It's, you know, and the crux of it was, hey man, if you're sitting on all this news, where is it? And then the stuff that we have announced doesn't exactly, you know, cause people to get really excited and jump up and down. But we took a little bit of a different approach this time, which I credit to my colleagues. We have, if you look at the past few press releases, you'll see it. They've been a lot more technical. They haven't been very exciting from a layperson's view, but there's a reason for that. It's because we've actually gotten business development leads from putting these out there because they get picked up in trade publications. So we've gotten new customers, we've gotten new partners. Actually, the 2 recent ones we announced were based off of a previous press release where we were talking about capabilities we had, and these companies came to us and said, oh, wow, we're interested in that. And so that's how we ended up launching audio, for example. Our partner heard about what we were doing through one of our press releases, and they said, hey, we're very interested. So we're trying to get the message across in the industry that we're relevant and compelling. Okay, and I'm being simplistic here. And unfortunately, that's kind of come at the expense of the layperson investor who looks at these announcements and goes, oh, I don't really get that. Why should I be excited about it? But why? Well, for one, it expands our offering. Expanding the offering means a more compelling reason for a customer to sign up with us. The more willing an ad agency is to offer our platform to their clients. So there is a method behind that madness. Now, are we interested in replicating what we did last year when we got we were very active in terms of investor relations, public relations? On a broader sense, yes. I think that is something that will absolutely start to tie in to what we're doing currently with the whole, sort of higher level things. And when that happens, I think that you'll see a broader base of investors being attracted to us because the messaging they're getting is a little more layperson friendly, if you will.
Okay. So this is going to be basically. So then there's still a pipeline of news flow that's going to be coming out in the next.
Yeah, it's effectively blending that in with the tack we've taken recently to be more industry relevant and be the phrase they use is thought leadership. So when you have executives being interviewed in magazines for e-commerce software or ad tech, they're not going to, no offense, but they're not going to pick this up, you and I talking about it.
Right.
And even if they did, no one would get excited. They think, oh, that's a little too promotional. But they get excited seeing things that are specific to the industry, views on M&A, views on product changes, views on macro changes within the industry, things that Google's doing, things that Facebook's doing, regulations, things like that. I mean, when you're featured on that basis, a lot more credibility is generated from that community.
Right.
What you don't want to do is do that at the expense of the investment community, because even myself, I mean, I participate in meetings internally all the time, and I hear phrases where I have to go look them up, and I'm like, gosh, what does that mean? But I know what it means coming out the other end, but transmitting that message back to investors on why that matters to them is an art, and I think we're about to go to art class, if you will. Yeah.
Fantastic. Okay, so it looks like things are moving forward. We got the margins increasing. Pretty much, it's essentially full steam ahead. Things are happening as we've been saying they would happen. So again, it's just a question of what's up ahead next for the company. Yeah. So, Brent, on that note, I want to thank you and look forward to getting a follow-up from you shortly, the next couple of weeks after Labor Day. Hopefully.
Sounds good, Jack. Thanks a lot.
And thank you, everybody, for joining our live stream today.